Well, again, welcome everybody. My name is Dave Floyd with Aspen Trading Group. We've been working with FX Street over the years, for a number of years, I should say. And I haven't done a webinar with FX Street in a while. I do a lot of commentary on their website and a lot of the videos that appear on their homepage in the mornings. Oftentimes our Director of Education, Bart Merrick, does these webinars, but he's away this week. And I thought it'd be great to do a webinar. I haven't done one in a while with FX Street, so wanted to thank everybody over at FX Street for having me here. What we're going to do today is actually pretty simple. We're going to put the context of today's presentation with basically in real time. We're going to discuss some opportunities in this market using the techniques and the approaches that we use here at Aspen Trading. So I'm going to walk you through some real basic, simple setups and kind of give you the know-how on how we do that. So for those that may not know or be familiar with my background, Aspen Trading, I founded this back in 2002. So we've been around for a while. Another guy who I'm sure you all know, Todd Gordon, who's a longtime friend of mine and trading colleague, joined Aspen Trading, coming up on 2 years ago. 2 years ago or 3 years ago? No, 2 years ago now. We've been trading colleagues for a long time. It was the right thing to do for us to team up. Our trading styles were very similar but different enough where we can offer good perspectives and a good blend of insight to our clients. So it's good to have Todd on board. So I've been trading FX since 2002. Prior to that, I was equity trader from 1994 to 2002. Owned one of my own equity firms down in San Diego, the infamous day trading firms, which was a fantastic experience. And then, of course, before that, I was in the corporate world at Standard Chartered Bank, where I was a bond trader. So technically speaking, I haven't had a real job since 1994. I've managed a couple companies, Aspen Trading being the second one. We also have a small money management firm that we manage money for some close friends, colleagues, and whatnot. And I think my big recent accomplishment, which I'm quite proud of, was finishing up my MBA, my executive MBA actually, over at the University of Oxford, and I did that a year ago in September, finished that up. That was a 2-year hellacious journey of work during the day, study at night, classes once a week over in the UK. So it was a great experience. I can tell you that I'm happy the schoolwork's over. I know Todd's happy to have me back because running the company kind of solo for 1 week at a time, that was, let's just say, taxing. So with that said, why don't we go ahead and get into it? I'm going to talk about the first section of the presentation from the I.P.A. methodology. And the one thing I've learned over the years, in fact, I think I knew it all the time, but I've just had a much easier time now boiling it down to kind of express it to others and to other traders, is I've always tried to keep things very simple. When I was a day trader, and for those of you that have day traded, and when I say day trade, I mean in the classic, what I would consider the classical sense, scalping in and out 30, 40, 50 times a day, depending on what the volatility was, you didn't have time to get hung up on chart patterns and retracements and all that stuff. You're kind of trading a little bit by the seat of your pants. A lot of feel, gut, intuition. It is probably trading in its most, boiled down, simple, raw nature. There's not too much complexity you can add to that. I mean, you can add to it, but you're going to get lost in the trees. So I think by starting out on that time frame was a blessing in disguise, because since then, nobody wants to be banging the keyboard, for 3-4 hours a day to make a living. Eventually, that does wear on you. Markets change, and you need to adapt. And I would say, largely speaking, that type of hyper trading is largely done by computers now. I do have a few colleagues that still do it, but by and large, if you evolve as a trader from that short-term time frame where you're keeping it very simple, it makes the progression as a trader to trade higher time frames in different asset classes that much easier, because you've distilled a lot of experience through the day trading, a lot of that feel and instinct, which you don't get from just looking at a chart or just reading a research report. So the I.P.A methodology is really a culmination of a lot of those years of experience and boiling it down into a very simple 3-step process. That process being intermarket analysis being on the lower rung, the primary, basically the foundation, pattern recognition, which essentially is what we refer to as Elliott Wave, and then account and risk trade management. We think by combining all 3 of these components, you take out a great deal of the subjectivity that every trader encounters when they trade the market. And I know there's probably a few on here that when they heard the words Elliott Wave, they're like, oh crap, another Elliott Wave presentation. I don't understand this stuff. It's too subjective. I will agree with you, but with an exception. Elliott Wave on its own, as with any trading analysis, in my opinion, alone is one-dimensional. Elliott Wave is one-dimensional if you're just looking for wave patterns. And Elliott Wave obviously can be subjective. There could be 2, 3, I don't know what the old joke is, but you put 5 Elliott Wave guys in the room and they can come up with 5 different counts. The key for us, and I'm going to get into this in a little bit, is how you combine these 3 elements so that you come up with an objective approach to Elliott Wave analysis. And I'm sure that everybody now is like, aha, that's what I've been wanting to hear. An objective way to put Elliott Wave onto my trading screen so that it's effective. Because I can tell you, going back to 1994, I'm coming up on 20 years in this business. And you know what? I've seen a lot of different markets. I could tell you that Elliott Wave, for me, is probably the most objective way to gauge the market. And that's coming at it from a lot of different experiences and seeing a lot of different methods over the years. I'm not saying it's the only one. It's the one that works for me. And I'd like to think that I'm a pretty bare bones, simplistic trader. I don't get caught up in all the muck. I don't get paralysis by analysis. I keep it pretty straight. So that being said, let's go through and just briefly go over the 3 components to the I.P.A trading methodology that we've developed. The first one is intermarket analysis. And this, for me, for those of you that aren't familiar with intermarket analysis, it's essentially the study of correlated markets. If we can determine what markets are driving the price action in FX or whatever asset class you are trading, you now have some sort of a crutch to lean on, some sort of a guidepost. Something that's saying, well, if oil is moving higher, the Canadian dollar should be moving higher too. A very simple analogy. Canada is a net oil exporter, or Norway a net oil exporter. Higher oil prices should be bullish for their currencies. That's a simple correlation. And in fact, oil prices, and happen to be the analogy that I chose, oil prices are important when you're analyzing dollar Canada or dollar NOK or euro NOK or euro Canada. Very important. So that's intermarket analysis, how asset prices are moving and impacting each other. And as I happened to be listening to the previous 2 presenters this morning while I was getting ready for this, I had it on in the background, I heard that theme over and over again. Markets now are incredibly correlated. They're almost perfectly correlated to some degree. I didn't include a chart in here today, but Todd put together a chart a couple years back which showed before 2008, before the big credit crisis, we had relatively loose correlations. Markets kind of did what they did, and sometimes they met and they traded in tandem, sometimes they didn't. Since 2008, you can't tell the difference, largely speaking. So therefore, that to me says I have to include intermarket analysis as part of my overall strategy. Once I know what markets are moving, then I can determine what that impact is going to be on the various currencies that I'm looking to trade. The next step, of course, is pattern recognition. And I've already alluded to this. Pattern recognition could be anything. It could be head and shoulders patterns for some people. It could be cups and saucers, all the various patterns that are out there. It could even be candle patterns. It doesn't really matter. But what is important, for us, obviously, it's Elliott Wave. The important part here is that you're wrapping an objective analysis tool around the intermarket analysis. Now, I'll give you a good example. There are many Elliott Wave guys out there that are so bearish the S&Ps right now. I'm not saying they're wrong, but they've been beating that same drum for months now. In fact, years, you could even argue, with periods of bullishness in between. That, to me, is an example of one-dimensional analysis. You're just looking at the chart and the wave count that you've constructed and said, this is a bearish wave count. Okay, I get that. But traders have to be flexible, and they have to be looking at other items in the marketplace. If you overlay intermarket analysis and even to some degree fundamental analysis, you're going to see that that wave count's kind of at odds with what's actually happening in the rest of the market. It's at odds with what's happening in gold. It's at odds with what's happening in equity indices worldwide, with the exception of, let's say, Shanghai. But it's at odds certainly with what's happening in the S&P 500, largely speaking. We've been straight up since the 2009 lows. And yet we're continually looking for an S&P top, or some of these analysts are. Therefore, that takes, to me, the subjectivity out of Elliott Wave analysis. You're looking at these related asset classes, and you're saying, what's the wave count? I've got 2 to 3 possible wave counts here in the S&Ps. But based on what other related asset classes are doing, which wave count makes the most sense? That, to me, is how you can use Elliott objectively and not wonder when you go to bed at night, geez, I hope I chose the right wave count. Because you're boiling it down to the lowest common denominator. Lastly, is account and risk management. Again, no real mystery here. Everybody's heard the same argument. But if you can't manage your trade and manage your risk, it doesn't matter how good your analysis is. One of the things that we do that's pretty unique at Aspen Trading Group is that we gauge the trades that we go into on a tiering system. Again, going back to relying on experience and feel in the markets that we're in right now where we're just having a hard time getting volatility to pop up or down, or I should say not volatility, but we're getting price direction challenging to pop up or down, which means lower volatility. That's the type of market you don't want to be swinging for the fence. You want to be kind of going in, taking a little piece, testing the waters. If it doesn't work out, okay, little, minor flesh wound, no big deal. So we base all of our trades on how we feel, on our conviction level. We have 4 tiers for that. Obviously, if you're having we go from tier 1, which is the highest conviction, down to tier 4, which is, let's say, everyday neutral conviction on the market. By doing that, you're actually keeping your equity exposure limited when the market's not as robust as it could be, and then you're going for the throat. Now, in the previous presentation, I heard a story told, and I've heard stories similar to this told all the time. In fact, I used to trade like this as a day trader. I'd sit there and I'd trade 1,000 shares, 1,000 shares, 1,000 shares, and all of a sudden, boom, I'd come in with 10,000. Because I saw something. Something to me suggested that everything came together. It's the same thing with our tiering system. When we feel as though there's a really good opportunity, we want more exposure. And given the fact that you make 80% of your money in the markets 20% of the time, think about that for a minute, because it's true. You need to be going for the throat when the markets are most robust and be really scaling back, if trading at all, when the markets are kind of being stingy. And that is, for us, the key components of how we put together our daily trading plan. So let's move on to the next slide here. So as you can see, by putting together 3 very simple steps, intermarket analysis, pattern recognition, and then account and risk and trade management, you come up with a very simple methodology which will greatly improve your trading odds if you put them together correctly. And I think everybody, especially in a market like now when you're in a trading range, if you don't have a methodology that you can go through and kind of check the boxes and say, yeah, all the pieces are in place for a trade here, this is the type of market you're going to get yourself chopped up into. We're just not getting a lot of range expansion in here. So the bottom line is you need to have a methodology that is going to allow you to get into the markets when it makes sense and stay out. For us, it's I.P.A. Let's take a look in action. Let's go real time. Let's take a look at the market, or the IPA trade process right now. Now, I think everybody would probably agree that the last couple of days we've seen the S&P futures try to get bid in the early morning hours, try to break above that 1450 level, and they just have not been able to do it. And that has really been what's been challenging this week. I came into this week with a couple of really good ideas to get long New Zealand dollar. I know Todd was looking at, euro dollar. And given that our trades last 1 to 3 days, we want to make sure all the pieces are in place, but we're just not getting that follow through just yet. Well, lo and behold, last night, one of the things that was really quite helpful was the Australian dollar, the Reserve Bank of Australia's interest rate announcement. Now, I want to caution you, I'm not saying that was the reason that we said, hey, there's probably some opportunities here. We saw the opportunities ahead of time, and allow me to explain by bringing up the next slide. And hopefully this slide comes out clearly. If not, I can always bring over my chart, which may show a little bit better. And everybody, before I go on, because this is a really important chart, let me know if you guys can see this chart. It looks clear. Fantastic. I'm going to pause right here because I think there's an important question here. And I will take questions at the end. I would prefer to take questions at the end, but if there's a question I think that is going to prevent anybody from kind of moving on in terms of the presentation, in terms of understanding, please feel free to ask. I'll either answer it then or I'll come back and address it at the end. But there's a question in here about what does the Norwegian Krone have to do with oil? It has a lot to do with oil, because if you look at Norway, I don't know if they're the 7th or the 5th, but they are one of the largest oil exporters in the world. And more importantly, not more importantly, so as a result, oil prices, or the value of the Norwegian dollar or the Norwegian krone, is going to be very impacted by the movement of oil prices. Do a simple overlay of those two markets and you'll see that higher oil prices will drive dollar Norway lower, euro Norway lower, which is obviously a higher Norwegian krone. So again, it's those simple relationships that then allow us to take what you might see as a very bearish pattern in dollar Norway, and then when you lay it on top of oil and you see that oil is going down, now you have one extra layer of confirmation that you're on the right side of the market, not the wrong side. So for those that say that correlations don't matter in terms of trade selection, I'm going to disprove that in this next slide here. So everybody said they could see this chart okay, which is good because this is a really important chart. This is simply a feature that we use in our charting software, which is called Motive Wave. And Todd and I were pretty closely aligned in the development with this, with the Motive Wave founder up in Toronto by the name of Tony. It's an intermarket. All this simply does is it allows us to overlay various asset classes onto a time frame and then start that percent change relationship from whatever point you decide. So I just happened to pick the Sunday afternoon opening. I picked it back here, September 30th, 2 p.m. here on the west coast of the United States, which is where I'm based. And since then, it's showing the percent change of these various currency pairs against the S&P since Sunday. Now, if you want no further proof of the power of intermarket analysis, this is it right here. S&Ps are up roughly 0.5% since Sunday afternoon opening, give or take. This is captured about an hour ago, so it's probably a little less now because they've come off a bit. We can clearly see, though, that the Aussie yen is weaker, Aussie dollar is weaker. They're actually down on the week. Dollar Norway's down, which means that the Norwegian krone is strengthening, and the New Zealand dollar and the euro are strong. Can anybody tell me, if you're going to be trading with the expectation of the S&Ps moving higher, meaning risk on, which of these currencies do you not want to trade to take advantage of a risk on type trade? Well, I think I know why Mike said NOK, but remember this is the inverse. Or think of it this way, as US dollar Norway goes down, that means Norway's gaining strength. So you actually do want to be considering short dollar Norway because it's off more than 0.5% while the S&Ps are up 0.5%. Remember, those are inversely correlated. And if you need some further explanation, we can kind of come back at the end and work on that. But the most obvious answer is Aussie dollar. Why would you want to be trading Aussie dollar against the S&P, which is what normally people do, when it's lagging it by almost 1%? So this alone tells you that if you're not looking at correlations, you're missing a huge piece of your trading puzzle. Because if somebody came in and we both sat in the room and we saw the S&Ps rallying, one guy bought the Aussie and I bought Eurodollar, who's likely going to make more money on the trade and quicker? It's going to be me, because I'm buying the relatively strong currency relative to the S&P versus the laggard. So again, for those that say intermarket analysis or correlations aren't important, I point you again to this chart. It's very simple. I look at this chart frequently throughout the day, and I also look at various look-back periods to see which are the lagging and the leading currencies. Now, if we thought that the S&Ps were about to fall off of a cliff and go down, I'm just using this as a hypothetical example, guess which one I want to beat up on? Aussie dollar. I want to be short that thing. I want to be short Aussie dollar if the S&Ps are going to weak because it is leading to the downside. So correlations are always in flux, but the fact of the matter is a simple look at a chart like this, an intermarket overlay, which we profile all day to our clients in our research services, is going to keep you at least on the right side of the trade, so to speak. It's going to allow you, again, I go back and harp upon this one point. It's going to allow you to go back and put the wave count that is most robust onto what's happening currently. So therefore, if I've got a bullish pattern in the euro, I now have confirmation that euro is not only stronger than the U.S. dollar, but it's likely to rally when the S&P, I'm sorry, I mean to say U.S. dollar, the S&P 500. So that when the S&P 500 rallies, I'm reasonably sure euro is going to rally too. That takes the subjectivity completely out of Elliott in that case. Therefore, if you're working a bearish count in the euro right here, I would say, really? I'm not saying it's wrong, but I would say you might want to reconsider that. It doesn't look as though euro is terribly bearish right now. So, using that logic, euro the strongest, Aussie the weakest. Okay, let's think about that for a second. If we want to have a trade based on that, we have two options. You don't want to be short the Aussie dollar. And you might say, well, why not? It's down. You're right. It could go lower. But if our forecast for a higher S&P remains intact, Aussie dollar is not going to drop very much. In fact, it might still even rally, but again, be a laggard. We could buy euro US dollar. I won't argue with you there. I'll show you the wave count in euro a little bit later in the presentation. But what about this? What about this? Using this intermarket analysis, which to me is pretty darn simple. You're looking at percent change on the chart to identify the laggards and the leaders. And then I would walk away going, if the euro is the strongest and the Aussie is the weakest of the ones that I'm profiling right here, which are the main currency pairs, why wouldn't we consider getting long euro versus the Australian dollar? Think about it. Euro is the strongest, Aussie is the weakest. So what I'm going to do at this point, I'm actually going to bring over some live charts. I will come back to the PowerPoint presentation, but I want to show you. First of all, before I go on, does everybody understand the logic that I use to arrive at that conclusion as to why we should consider longs in euro Aussie, or at least at the very least longs in euro US dollar, and not look at the Aussie dollar as our vehicle in here? Because it's a really important point, and I hope I made it as clear as I could. Okay, fantastic. Because remember, as a currency trader, it is my belief, and it's a pretty strong belief, that if you're not looking at the S&P 500, interest rates, major commodity markets, you're only getting half the picture. Now, for us, the S&P 500 matters a lot. And for us, and I'll show you in a little bit, we're bullish the S&P 500. We think we're kind of in a fourth wave nasty correction right here, or I shouldn't say nasty, complex, which I guess makes it nasty. But we still feel as though the S&Ps are going to break to the upside, and as a result, we want to be fishing for trades that are in harmony with a bullish S&P forecast. So that being said, let me bring over the Euro Aussie dollar. And this is where I'm tying what I've talked about thus far into a real-time trade or a real-time scenario that we're tracking currently. So now, there's a lot of labels on the chart. That's Elliott Wave analysis. I can't really say anything about that. Then I'll bring it over in just a second. Let me just tidy this up so it's as clean as possible. Yeah, let me get rid of these. And it grows. So, ta-da! Here we have the Euro Aussie on a one-day chart. I've heard in some of the previous presentations, oh, why is it doing that? Don't do that, please. Please don't do that. Is my screen, there we go. Much better. No, why is it flickering? It's very annoying. Is the screen flickering? Refresh the cam. Good idea. Hadn't thought of that. How's that? Perfect. Geez, what would I do without you guys? Relative novice. Oh boy, somebody else is in this presentation. I think I know that guy. So we're looking at Euro Aussie dollar right here. And from an Elliott Wave standpoint, or even if we took the waves off, let's use the magic of charting packages. Can anybody tell me what the trend of Euro Aussie is right here? If nothing else, forget Elliott Wave. Just let's look at the trend. What is the trend on the daily chart right here? We don't need any comments from Mr. Gordon. Yeah, exactly, it's up. So even if you didn't do Elliott Wave and you did that simple intermarket analysis that we just went through, you'd know that this is a candidate that you'd probably want to be considering on the long side. You could take it a step further and use real basic, pattern recognition, gap higher off of a flag or a pennant formation in here. Well, let's go back to our tried and true method, which we firmly believe in and we really anchor our analysis in. So we've agreed on the daily chart. We agree that the trend is up. We're calling this the possible wave, 5 waves up in A, a very shallow pullback in B, and then another 5-wave move higher. But let's drop this down to an hourly chart. And let me shrink up the bars a little bit so we can get in there and get real granular. And add some waves in here. So from our perspective, we are bullish on this. We don't want to be, buying this breakout right here. But now that we've established the baseline scenario for this, meaning that the Aussie dollar is weaker than the euro, we've got a bullish wave count, we've got a potentially bullish S&P count, although this one's moving without the S&Ps today, so you could look at that as a major positive, that this will move higher as the S&Ps push higher in the days ahead. We want to start isolating a pullback in this particular currency, in this cross, I should say. So from an Elliott Wave perspective, by being able to gauge the wave count, we're going to know that when we start to get a correction in wave 4, we'll be able to begin isolating Fibonacci support areas for that. So let's just say, for the sake of argument, that we've completed wave 3 right here. We probably are pretty close to getting into the completion of wave 3. Why did it do that? At any rate. So what we want to start doing now, if we believe we've completed wave 3 and we start to correct lower, we're going to want to start to isolate areas whereby we want to be buyers. Because we're going to buy on the belief of the continuation of the trend. And within Motive Wave, we can do some very simple routines. We can just simply click on the line between waves 3 and 4, hit ratio analysis, and it'll show you the ratio between waves 4 and 2. Now, typical ratio is usually going to be about 100% the distance of wave 2. That's going to take us down to about 125.40. I want to pin that ratio right there. The other thing that we could consider is the distance of wave 3, the distance of, the pullback in wave 4 relative to the distance of wave 3. So again, these are simple Fibonacci relationships that everybody on this call, I'm sure, is familiar with. And we come up with this sequence. Fibonacci retracement at 23%, 38%. The ones that are in color are the typical projections for a wave 4. So if we can begin to count 3 waves down into this zone, and then maybe you as a pattern recognition trader on your own, you know we're in an area of support. That's the area you want to start nibbling at this if you're getting confirmation from your other asset classes. Now, of course, we can't trade below the wave 1 high, which brings us down to 124.21. So we know that the line in the sand for this particular trade is 124.21. So I'm just going to draw in something real quick here. There it is, wave count invalidation. So by just simply taking, come on mouse, by simply taking this simple wave count, we know now where our stop is. Our stop has to be, or prices cannot trade below 1.2421. If they do, this wave count's invalid. So we have a built-in stop loss. If we get filled into the 125 area, we've got an 80 pip stop loss. We've probably got much more than 80 pips on the upside. We've probably got a 2-to-1 payoff right there. But that will evolve as the days unfold ahead. Or I'm sorry, as the hours unfold ahead. The point I'm trying to drive home with this illustration is that we arrived at a currency pair that is likely to be best positioned for the market environment that we're in right now. And I think that's the key thing. Does it mean the trade will work? Not necessarily. Is it better than trying to buy the Aussie dollar? Absolutely, based on what we know right now. Now, RBA came out and raised interest rates for some stupid reason. Well, that all goes, to the wayside. But that's not my point. We go through that process of elimination using the intermarket overlay chart. And by doing that, we arrive at what we would consider the higher probability currency to trade, and we put a wave count that fits in with the overall macro intermarket analysis environment at that time. So pretty clear on that? Now, this is a trade, as you can see. I know everybody has different time frames that they trade. We at Aspen Trading tend to trade on the 1 to 3 day time frame. I do tend to push some of my trades out a little further, and I'm going to go over that in a few minutes. But what we're trying to do each and every day is go through this exercise and then present this to our clients. We may only have 4, 5, 6 trades a month because, as you can see, you're just like some of the other previous presenters had said today, you got to wait for the market to come to you. You got to plan your trade and then trade your plan. And the other thing you have to do is you have to realize that the market's not there for you to take out a predetermined amount of money each day or week. You can only trade when the market's ready for you, not the other way around. Now, this particular situation right here, this is setting us up into what I would consider a pretty solid trading situation that we haven't seen in a few days, and probably in about a week actually. This is coming together really nicely. We've got a lot of pieces coming together. The intermarket, the Elliott, the account risk management, which will overlay when we get closer to executing the trade. We've got the potential to make a really nice trade in this one, probably over the next several hours, day or two, as this thing pulls back in wave 4. So, for those of you that are trading on smaller time frames, you can use the same logic. We definitely try to profile shorter time frames within the service from time to time, but we don't normally trade on them. But we do realize that traders do like to trade on those shorter time frames, and we'll certainly profile 15-minute charts and kind of show you some different scenarios there. I'm going to pause here for just a moment, kind of take a look at some of the questions in here before we go on and hit a couple of other points that I think are pretty important in here. So just give me a second here to read through these. Mike has a question here regarding the Copic indicator. I'm assuming he says, why did you pick it over stochastics, RSI, CCI, or MACD? You know, Mike, for me, the bottom eighth of my chart is always an experiment. I would be lying to you if I told you that I'm using the Copic indicator to determine our entries and exits, but I'm always curious and looking at different things that are more standard on your charting packages to see what might add some value. What I've seen thus far, and again, this is coming from a very limited data sample, the Copic seems to be a little bit less noisy than some of the oscillators. Now, I'll admit, as a day trader, I lived and breathed by the stochastics. I mean, that's how I made my money. So I'm not going to sit here and say that oscillators don't matter. But I think when you put it in the, hold on for a second, some background noise. But I think when you put oscillators in the context of Elliott Wave, you can quickly see that Elliott Wave is already telling us that we're approaching a top, and you don't need the oscillator. Now, if you want to just, rely on that as a crutch until you get more versed in your Elliott Wave, hey, why not? Again, I don't care what you use on your chart. If it works for you and it's objective and you have a proven methodology to wrap around it, great. For me, I'm always experimenting with a couple of different things, but the fact of the matter is a lot of these indicators that are widely available on charting packages will tend to lag what Elliott Wave will tell you once you get versed at doing the Elliott Wave analysis. And we do all that work for you anyways. You don't have to be counting the waves, but certainly if you want to get involved, you can do that. But that's what we're doing. We're going through all the procedures behind the scenes, and then we're promoting it, or we're highlighting it in the research, giving clients not only specific trading recommendations, but just our observations and what we're seeing develop in various asset classes throughout the day. And you can use that to go on and make your own trades. That's the beautiful thing about it. We'll give out what we consider useful information, and you can take it and shape it and use it in the way that you see fit. Now, kind of moving on, I'm going to go back to the presentation a little bit here. That's how we, got to reset my camera, hold on. There we go. So that's how we go ahead and, through the process of elimination, get down into the nitty-gritty of the things that we want to trade. Some of you are going to ask, I just explained to you I.P.A. will certainly work on shorter-term time frames, but you're probably going to get less into the minutia of the correlations. But I would still argue that even if you're looking to trade something on a 15-minute chart, you're going to want to make sure that whatever that currency pair is, that it matches up on an intermarket analysis standpoint with the related asset classes. Again, case in point, maybe Aussie is not a good example because it's down on the day due to some, the RBA news. But if we had taken Aussie in isolation yesterday before the news, before it got sold off, even if you're trading off of a 15-minute chart and you see a great technical setup in the Aussie dollar, and you think the SPOOs are about to rally and you want to kind of latch onto that, again, it goes back to this chart right here. Which one's going to give you the better bang for the buck? Well, the answer is euro. Okay, so let's look at this. Let's use the same logic, but for a higher time frame. Some of our clients, and perhaps even some of the attendees on today's conference call, aren't necessarily interested in trading off of hourly bars or 15-minute bars or even 4-hour bars. They'd rather just kind of use that same I.P.A. approach, get a bird's eye view, let's say from a 4-hour chart and higher, and try to isolate a good entry and try to ride the trend. Now, granted, what comes with that, though, is wider stop losses, so you'd have to adjust your lot size accordingly to keep your risk profile consistent with what you normally have it. But having a combination of having something work in the background in conjunction with the shorter term trades can be really quite useful. And as a case in point, we've been highlighting trades in our research over the last year or so, the longer term trade setups, but we've never we never profile them as specific, or I should say official recommendations, because our clients have become so accustomed to having relatively tight stop losses. We just simply wanted to profile these, and they were because they were of interest. But what we've come to find out is that there is a certain percentage of our clients that like that. We're going to start offering those longer-term trade setups as official recommendations as they come about. Now, as you can imagine, they're not going to come about every day or even every week. You might get one or two a month if you're lucky, but you could be in them for several days, several weeks. And for some people, that works really well. And that's why I kind of put the picture of this guy on the couch here. There are a component of traders out there who want the lifestyle trade. Rather sit on the couch with their laptop, or maybe they're traveling, or maybe they work a full-time job and they can't really monitor the markets as often as they'd like to. These are the types of trades where you can still be involved and not have it be a major hassle to your daily schedule. So here you got the guy chilling out on the couch. I suspect he's short Euro Norway, which is the trade I'm about to profile, because you can see the guy's smiling. So, and given that trade's worked out thus far, I'm going to guess that's what he's short right in here. So a couple weeks ago, about last week, I believe, identified something again, going back to Euro Norwegian Krone. And I know some of you might be saying, jeepers creepers, why are you trading that cross? Well, that's a good question. That's a good question. And maybe I'm a little sensitive to people getting a little, kind of uppity about looking at anything other than the euro or the yen or the Aussie dollar, which, by the way, I love trading Aussie dollar. So I hear you. I'm with you there on the good vibe that Aussie dollar gives off as a trader. But the fact of the matter is there are some other currencies that really match up quite well when you look at it on a macro/intermarket analysis standpoint. Euro NOK happens to be one of them. Again, I go back to that correlation. Oil relative to the Norwegian krone. Now, you can make the argument in here that maybe the upside in oil is a little bit limited from where we are right now, and I can show you that chart, and I think you would agree. But largely speaking, Norwegian krone is outperforming the euro. Now, the technical pattern on it also was compelling to me. I'd identified a top in wave 4, purple wave 4 right here, and kind of waited to get some confirmation that we were moving to the downside. Had a little modest rally in wave 2, and we started to break lower. So I profiled to clients. I said, hey, you know what? If you're willing to go with about let me pull up the chart here because I'm having a hard time seeing it on my screen, on that screen right there. Hold on for a second. Oh, of course, my screen's going to get all goofy again. Bear with me, guys. I'll fix that in just a second. Yeah. So I said to the clients, I said, if you're willing to go with about a 600 to 700 pip stop loss, and before anybody falls on the floor about recommending a 600 to 700 pip stop loss, bear in mind, pip values on Euro NOK are only 17 cents. So now that you can kind of collect yourself and say, okay, well, I can handle that. I can't do a $700 stop per mini lot, but I can certainly consider a $170 stop per mini lot. So if you're willing to sit there with that type of a trade, that type of exposure, and I guess the important thing is really not the exposure, because you can always adjust your lot size so that you're not risking any more than you would on a shorter term trade. It's the ability to kind of sit there and manage the position effectively. But if you're able to do that, the position's moving in our favor. We got short in and around, was it 741.52. I'm having a hard time reading my chart here because it's so small on my particular screen. And now we're trading down around 736. So we've had a nice move. That wasn't it. It was 743.15. I apologize. We've since lowered the stop loss, so we've protected our profits in here. And can anybody tell me why we chose this particular level for the stop loss? I'm just kind of asking a random Elliott Wave question here to see if anybody happens to know. Mike said past support, and I think that's a great answer. I'm going to take it a step further, though. And if you're not familiar with Elliott Wave rules, you may not know the answer, and that's perfectly fine. But certainly past support is valid. And it's also what you could call now resistance. Support has now become resistance. But from an Elliott Wave perspective, this wave 4 pullback right here could not have traded into the area of wave 1. So that for us is our objective stop loss. Therefore, it made sense for us to take the stop loss from here and lower it to here. We have locked in profits now in the event Euro NOK trades higher. Whether or not if it does, I don't know. Technically, I can see this thing trading all the way down towards 733, 732. That's another 400 or 500 pips. And I can even see it moving beyond that. But again, whether or not we stay in it quite that long, that'll depend on how the market develops. So what I've walked you through thus far is I've given you not only a trade that we're looking at currently to execute on longs in Euro Aussie, I've given you an idea of using it from a longer term perspective and showing you a trade that we're currently in, that we'd profile to clients, and we'll continue to profile these longer term trades. And of course, I'm going to leave the rest of the presentation open to questions. We can look at various charts if you'd like. Looks as though we've probably got about 5-10 more minutes on here. The one thing I did want to do, though, the folks over at FX Street have always done right by us. They've always allowed us to get our commentary posted. They've worked well with us in terms of promoting these webinars, as well as on the commercial front. And one of the things that they've done, we've worked out with them, is that if you want to take a trial to our service, normally it's $10 if you come to our website. But if you go to FX Street's website, and I'll put the URL in the dialog box right here. But if you go there, you can take a trial with us for free. It's a 14-day trial, won't be a $10 charge. Let me get that URL. I'll put that in there for you guys. Hold on for 1 second. So you want to go to this URL. I'm going to pop it right in the box there. And that'll allow you to get the 14-day trial for free. And I think what you'll see is you'll see a lot of the analysis that I've done in here today posted throughout the day. And then when we have a new trade recommendation, we'll push it out not only onto the service, but I'll also email and text it to you as well. So with that said, by all means, take advantage of that offer. And I'm also going to put this up kind of as a background screen for a couple minutes while I make a few parting words. If you want to contact us, here's our contact information. If you want to get us on Facebook, great. If you want to get us on Twitter, please do. We use Twitter not only for, market-related commentary, but just commentary in general. I mean, there's more to life than trading, and sometimes a little light look at things in life can be entertaining. So get us on Twitter, keep up to date on what Todd and I are doing, not only in the markets, but just in other areas as well. So with that said, let's turn to some questions here. Gold question. Let me back up here. I want to make sure we're starting from the top here. Hold on for a second. Got the one on the Copic indicator. Do you correlate gold with Aussie? Yeah, that is a good question. I mean, the general consensus out there is that gold prices will move with Aussie dollar and vice versa. So let's do it the old-fashioned way. I'm going to take us off the screen right now, and what I'm going to do, I'm going to bring up the S&P intermarket analysis chart that I showed you earlier. Oh, let me reset the camera. Okay, should be able to see the intermarket overlay screenshot again. All the squiggly lines. Everybody can see that? Okay, perfect. So let's add in, actually let me answer one question because I think it's important. What software are you using? We are using Motive Wave, and if you go to our website, you can find it on our partners page or go to motivewave.com. Very good charting packages, it's a very good charting package, especially if you're doing Elliott Wave analysis. It's quite good. So let's add in the gold. Not the gold. Instrument overlay. And I'm going to add gold in here. So the symbol for gold on my platform is QGC. Oops. QGC. There it is. I don't want to show the legend. I'm going to put it in, what color should I use here so it differentiates? That might not show too well. let's put it in this dark, no, I already have dark purple. I'll just put it in that line right there. No? Yeah, let's do that. Big hash line so we can see it. Okay. Gold here is in the black hash line. Aussie dollar is down here in the blue line. Now, it might be a little difficult to see. What I guess I can do, I don't really want to do that. But what you can largely see, I was going to take off all these different currencies, and I'm not going to do that. But largely speaking, gold does correlate with the Aussie dollar. It's not one of the prime things that we look at. I think the S&P and obviously to a lesser extent China, although those two are joined at the hip, but that's probably a conversation for a different day. Gold and the Aussie dollar are certainly well correlated. It's certainly something you want to look at. I think the S&Ps and the Aussie dollar might be a better correlation, although that's diverged for some time as well. Right now, I think Aussie dollar, as long as the S&Ps are firm and Aussie dollar is trading weaker, it does kind of make it tough to trade it against the U.S. dollar if you're trying to stick with the overall theme of the market, which is why Euro Aussie is probably the better bet in here. So again, we use Motive Wave software that allows you to do this this percent change. And again, it's what drives what we do each and every day. As I said, I profiled this from the Sunday opening. You know, I could go back to whatever date range I want, and it's going to calculate the percent change. I know when the Fed announcement came out, 2 weeks ago, I guess almost 3 weeks ago now, you know, we were running percent changes from the time that the Fed made the announcement for QE3, because then you were getting relevant percent change information based on new news. It wasn't being mucked up with all the previous news. So oftentimes when we get these inflection points, it's a good way to kind of isolate where you want to do the percent change from. The Russell 2000, a good comment in here, the Russell 2000, this gentleman says he hears that the Russell 2000 has a good correlation with the Australian dollar. That makes sense. I've never ran that, but it does make sense simply from the standpoint of Russell 2000 is considered kind of a risk-on, or let's say a little bit more risky stock index than, let's say, the Dow or the S&P. And the Aussie dollar, of course, is considered a risk-on currency. So that would make sense. You've got two risk-on asset classes that presumably should move in tandem with one another. What's really interesting, though, right now is China. It seems as though China, the Shanghai Composite, continues to, you know, skid around the lows, yet it hasn't dragged the S&Ps lower, and it hasn't really it's dragged the Aussie dollar lower, but not to the same extent. So you've got some really funky things going on in some of the intermarket analysis. I mean, you know, intermarket analysis doesn't give you the most robust correlations all the time, but it's certainly a very effective tool than not using it at all. So I think we are pretty much towards the end of this. I know we have another speaker coming on at the top of the hour. I'm going to want to let them come in, do their sound check, and get their slides set up. So unless there's any last-minute questions, again, I want to thank the folks over at FX Street. Again, they've always treated us well, given us an opportunity to you know, come and speak to everybody there. And I would encourage you folks to take the trial. Take a look at what we have to offer, and it'll really give you a sense of how you can get a good, simple three-step process around your trading analysis. Oh, there's no one asking me. Okay. Good question on the charting package. I guess I could put my sales hat on here. I got to answer the question, don't I? So there's a couple of ways to do the charting package. You can buy it outright, obviously. I can't recall the exact price, but it was in the $1,500 range. You can also lease it on a month-to-month or a quarterly basis through us by bundling it with one of our service packages. So that's an option too. Therefore, you're not incurring that big chunk right off the bat. You can kind of basically lease the package, pay for it monthly, and bundle it with one of our research services. Because at the end of the day, what you want to do with any charting package or any trading methodology is you want to understand how it works, but then you want to see how it works in real time. And that's the advantage of bundling those two things together for us, is that you got the charting software that we use, And then you're getting our updates throughout the day, and you're seeing how we're using the software to analyze and forecast the markets. And it just makes the learning process easier. And I got to tell you, you know, and I'm not being biased here, there's no other software that I'm aware of, if you're an Elliott Wave person, that makes it that much easier to get your waves labeled in a quick manner. So it creates a big efficiency in terms of your time. So if you're an Elliott Wave person, strongly encourage you to look at Motive Wave. It'll certainly make your life a lot easier than having to manually draw your labels onto the charts. It does all that in very quick and simple routines, and we're going to be coming up with some add-ons to it as well. Todd and I are thinking about or devising some drawing tools that can do some simple profit and stop-loss projections, so you don't have to know how to do wave counts necessarily. If you can pick swing highs and swing lows, it's going to give you the tools you need to give you some predefined points of where stops and profits should be taken. So that'll be forthcoming probably in the months ahead. The charting package is not available on the 10-day trial. I tell you what, if you want, email us, and I'll put the email in here. No, the email wasn't on that one. Let me put the email in the box here. Shoot me an email. We'll see. We might be able to do something. I don't know, but I'll talk to Todd about that. We could probably do something. If you're certainly interested in Motive Wave, we don't want to turn it away. 10 days may be a little bit short of a time to get up and running on it, but shoot me an email. We'll see what we can do on that. So with that said, that is all we have. I appreciate everybody coming by. Have a great, well, let's see, I've still got another hour here in the morning on the West Coast. So have a great morning if you're on the West Coast, great afternoon if you're on the East Coast, or a great evening if you're in continental Europe, or if you're in Asia, you're asleep or should be asleep, but you're listening to me, which I greatly appreciate. So have a good one, and look forward to seeing you guys at Aspen Trading, and we'll obviously be posting at FX Street periodically as well, so look for our stuff there as well. Take care. Have a good one.